Hello, hope your weekend has been awesome. In this video, we're going to be taking a look at Netflix. We haven't taken a look at the company since a while now. And generally speaking, it has been going down, even though in the past few sessions it has been doing a little bit better. If you take a look at the 1 year chart, you can kind of see it very clearly. The stock has tumbled from what it used to be. Over here, for instance, you can see it being near $700 for a long while, actually. And then it started tumbling and tumbling and tumbling, went over here 174 even over here, and then it started going up again. So is this an opportunity, or maybe we should wait to for the company to potentially go down in terms of its stock price? Let's take a look at the financials and examine what this company is doing and whether it's a potentially interesting case for a buy here. Now, the company's PE ratio is sitting at 28 here, and it's one of the lowest ones that it has ever been, as you'll see. If you take it back to 2017, the company had a PE of 220, which is incredibly high, of course. It means that it's a very, very high multiple of its earnings, making it an expensive company. Now, if you take a look at the price to free cash flow, things are even worse, and that has a lot to do with what the company is spending for, producing all the shows that it produces and, the movies. And so the company is not really making a ton. It's barely making any free cash flow, and this is problematic. And I'll tell you a few things about what the company and how this company operates when we take a look at the financial statements a little bit later. But it's worth noting that free cash flow gets back into negative territory after it has had, I guess, a couple of years and a good run because of COVID, because a lot of people were actually sitting at home and they had more subscriptions going. Now, in terms of the liabilities that the company has, there are quite a few compared to the free cash flow, and they are negative because the free cash flow is negative here. And the outstanding shares of the company are slightly up, but not at a point that actually is a problem for us. Like 3% is okay, is acceptable. But usually with companies, we want this to go down. We want the company to actually buy back its shares and basically retire them, because when they do that, our shares are actually worth more because there's less of it in the open market. Now, in terms of the revenue growth, the company is still growing, which is obviously a great thing to see. Sort of like a nice expansion here, like $12 billion to 30. That's a pretty nice expansion. The net income of the company is also growing, as you'll see, so the company does make more profit here. And the free cash flow is also growing, but remember that, we had the years of negative territory here. And since the company used to be negative, like minus 2 billion, right now they're sitting still at negative territory lately, but closer to zero than 2 billion. So they are up about 100%. Now, in terms of total equity, 300% higher is what the company has been doing. Remember, this has to do with outstanding shares as well being pretty much issued here. As you'll see, the company's net income margins are sitting at about 16%, 17%, and they have been climbing, which is nice for the company. It means it's getting more and more profitable. They are able to make more net income on their shows, on their movies, and basically their operations. And the debt-to-equity ratio of the company is less than 1, meaning that the company is relatively solvent, yet they don't have a lot of debt compared to the equity of the company. As of course, this is important because we can also compare it to the free cash flow, and the free cash flow is not a great picture over here. Now, let's take a little bit of a look at the financial statements, because taking a look at the numbers themselves in a concise manner here in our tool with using our table, it's a very nice way to tell a story about what the company is doing. And remember, you can gain access to our tool here by becoming a Patreon. The link is in the description box below this video if you're interested. Basically, you can analyze all sorts of companies that you like. And you will see that the revenue of the company from almost 12 billion here to 30. So very nice expansion here in terms of the revenue. You'll see it's all green over here. And the same thing with the net income, again growing from $500 million to 5.1 billion. So this is a company that is actually selling a lot and it's actually making money. So that's a good thing. However, when you are making net income, you also want to include what kind of capital expenditures you have, for instance, and take the operating cash flow and convert it to free cash flow. We're going to check that later, because remember, this is a company that is super capital intensive, right? In order to be selling movies and entertainment to people, you have to produce those, and this takes a lot of money. This is why you are looking at high capital expenditures for a company of this sort. And the balance sheet of the company, as you will see here, Two important things: the total liability of the company, total liabilities sitting at about $28 billion, and the total equity at $15 billion over here. Pretty healthy stuff over here. And the total assets of the company at $44 billion, with a total debt of about $16 billion, which is as much as the total equity. Remember, we saw earlier that is the total debt to equity is about 1. So this is what it reflects pretty much. Now, if we take a look at the cash flow statement, this is the most important thing. Remember that we are starting with $5.1 billion, and then we are adding back the non-cash expenses like the stock-based compensation, some depreciation, amortization, which is extremely important for a company like Netflix. It's going to be amortization. What's the difference? Depreciation, amortization they sound similar, and they are similar. The difference is that depreciation is about tangible assets. For instance, a car depreciates. Amortization is intangibles, like, for example, a movie depreciates, so it's worth more today than it's going to be worth in like 10 years, for example. So it depreciates, it loses value. So this is what you are seeing here, the $12.44 billion being added back, because it is amortization, which is a non-cash expense, but it is an expense. So this is why it's getting added back here to our cash, to our operating cash flow, taking it to about $300 million over here, because they had the one-offs here, non-cash items of about $17 billion. And you will see that the operating cash flow of the company has been pretty much in the negative for many years. It was only 2020 where the company made $2.4 billion. Remember, it's about the COVID era pretty much. This is when the company had its best years. Now they are probably not having as many subscribers as they had back then, and for sure we know that they have lost quite a few subscribers lately. Now, if we take into account the capital expenditures that the company has, then we're sitting at about a free cash flow number that is at about minus $132 million right now. And again, 2020 was the year where the company actually did well. But before that, minus 2 billion, minus 2.8, minus 3.1. And then it's not as bad as it used to be, but it's still in negative territory. And remember, when the company is making basically no free cash flow, what is its market value, its market capitalization pretty much? What is this number? We can see here that the company is currently worth $148 billion. So you have to deeply think about this within yourself. If a company is worth $148 billion, does it make sense that it actually makes zero in terms of free cash flow? If you think about it clearly without having any sentiment, this is extremely expensive. Of course, you can say that the company will keep growing, and it's a company that does well. They have a massive amount of subscribers and all that, which is true. But the fact remains, it is a company that is extremely expensive. It is a stock that is extremely expensive compared to what the company actually makes. $148 billion for a company that makes no money. If I told you to buy this company at a private level, would you buy this company for the amount that is being asked over here? Doesn't make sense. It's extremely expensive, and this is how you need to be looking at these companies. Don't just look at the name, look at the numbers. Take a look at what the company is doing financially. This is how you spare yourself of some trouble. Because remember, and you can kind of see it clearly here, the company tumbled. It was extremely expensive here, and it kind of still is, but we'll see how much, or maybe it's actually close to an interesting value here for a potential buy. This is what we're going to examine with our stock evaluator tool, which is extremely important here, because we need to know what kind of price it makes sense to pay for this company. And this examines how much the company is generating in terms of free cash flow. Because the company is how much money it generates to you, the shareholder. You don't really care so much about how many cars the company has, how much equipment it has. What you do care about is how much free cash flow they're making, how quickly they can grow this free cash flow. This is what you should care about. This is the only thing that is important to a shareholder. In terms of the revenue growth that the company has been achieving, you can kind of see here, this has been tremendous growth, frankly. 30%, 27, 24, 18. As the company is growing more and more, they're not going to be having these kinds of numbers. They're going to be growing less. So for this reason, I'm going to go lower here. I'm going to go 8, 10, and 12 in terms of the revenue growth that the company could be achieving in the upcoming years. Of course, being a patron and having access to this tool, you can try all sorts of values that you want to for your own projections. in terms of net income margin, this has been growing about 17% as we examined, and it's sitting at about 16% in the past few quarters. I'm going to go 15, 16, and 17 here for our net income margins. And the free cash flow margins, remember, the company is not really generating consistent free cash flow. When they were free cash flow positive, they were near 70%. And so we probably have to go around these numbers and kind of wish that the company will continue doing so, even though 2021 was a bad year again. Not as bad as the previous ones, but nowhere near the 70% that they did back in 2020. And so for this reason, I'm going to go 50, 60, and 70. And I'm going to see what this one gives us. Again, it has a lot to do with what you think the company is going to be doing, but even 50, 60, and 70% is probably already a little bit aggressive here. Now, if we hit calculate, you'll see that we're getting a 93, 130, and 175 for our projections here, and the current price is double that. So as it is right now, the company is extremely expensive, very, very expensive, nowhere near a buy. And I'd say, frankly, that $100 may be fair potentially, given the fact that the company, again, could continue growing for a while. But even $100 may be a little bit expensive for this company. Because again, it is not a company that is easy for this company to generate money, to generate free cash flow, and so it's always, or for a long while, going to be dependent on investors buying this company for no real reason, frankly. Given the valuation, that is, right? Because obviously this is a good company, but given the valuation, it doesn't make a lot of sense to be buying this company at these levels. And even at $100, it may still be expensive. And so you have to find people who are not really who would not really care so much about free cash flow, and mostly care about the company's name and the fact that the company has gone down a lot. Basically, a lot of people are actually buying companies based on that premise. But the thing is, as a value investor that is careful and not really just buying anything, you really have to take a look at what the company is doing financially and whether this kind of valuation makes sense to you. And so for a revenue growth of 8% a year, 15% net income margin, and 50% free cash flow margin, I think it does make sense to potentially buy this company at about $100 if it gets there. But 332, it's very, very expensive. It's nowhere near a buy for me. And this is what I wanted to talk about in this video. I hope you enjoyed this one, guys. If you did, take a look at this video that I made about maybe 10 days ago or so, maybe a little bit less, in which I kind of predicted that Bed Bath & Beyond will have a run, potentially, because this is what happens with bankrupt companies. But I wanted you to watch this video because it's very important and can save you some trouble. And watching this can give you an idea on what happens in these kinds of situations where companies are about to go bust because traders come in and trade those as trading instruments and not really as companies. So you have to be extra careful. Take a look at this video. It's going to help you if you are looking to learn more about how to navigate these kinds of situations. And again, thank you for watching this video. I'll see you soon. Bye-bye.